Last video, I talked about how Warren Buffett doesn't buy rental properties and why it might make sense to you. So today, let's dive deep into the juicy world of property investing. With so much chatter about the ups and downs of the real estate market, I'm here to simplify things for you. Let's focus on the fantastic four of real estate: appreciation, principal paydown, cash flow, and the delightful tax benefit. By the end of this video, you'll be evaluating properties like a seasoned pro. Hi, I'm Prudence, CPA and a fee-only financial planner. I help professionals and small business owners like you save taxes, accelerate wealth, and build good relationships with money so that you can enjoy and live the life you want and deserve. First up, my friends, is appreciation. Not the kind you get from posting a selfie on Instagram, although that's great too, but the kind that really fattens up your investment over time. So let's break it down. Imagine you buy a property today for $300,000. If that property appreciates at 5% a year, you're looking at a property worth about $382,884 in just 5 years. Yeah, you heard me right. That's like turning your average supermarket grape into a high-end wine. Both are good, but one's got a little more, shall we say, vintage. And get this, the magic happens when you buy this with a mortgage. Say you put 20% down. That's $60,000 of your hard-earned money, right? Now, fast forward 5 years. Just the appreciation part of this whole deal is close to $83,000. If you do the math, you'll see that the return is 138% on your original investment, or an 19% annualized return. I mean, if you were a stock, Warren Buffett would be writing love poems about you.
The very best businesses are the ones that earn a high rate of return on tangible assets and grow.
Now, why is this critical? Because appreciation is like growing taller when you are a kid. Everyone notices, and all of a sudden, you're not just reaching the cookie jar, you're slam dunking the cookie jar. You see, appreciation is more than just numbers growing on a spreadsheet. It's your financial freedom, building up block by block, like a financial Jenga tower. But unlike Jenga, you want this tower to stay up. Next, let's delve into the wonderful world of principal paydown. Think of principal paydown like going on a diet, you know? You are hitting the gym, you are cutting back on the midnight snacks, and at first you're like, am I even losing weight? Then one day you put your favorite jeans on, boom, they're sliding off your hips like they're 2 sizes too big. It's the same with principal paydown. It's subtle but powerful. So let's put it in real terms. Imagine you have a $1,000 monthly mortgage payment. Out of that, maybe $600 goes to interest. Yes, the bank's gotta get its cut, right? But here's where the magic happens. Another $400 goes towards reducing your actual loan balance. That's right, it's like paying the bouncer to get better seats at a sold-out concert. Except the concert is your financial future. So every time you make that monthly payment, you are owning a bigger and bigger piece of your property. It's like you start with a slice of the pizza, and every month you are getting another bite until you own the whole pie. And don't underestimate the snowball effect here. Over time, that $400 a month becomes $4,800 a year, and then $57,000 in 10 years. Why is it not $48,000? Good question. Because each month you'll be paying a tiny little bit less in interest and a little bit more in principal. Isn't that wonderful? Before you know it, you've paid down a significant chunk of your loan, and your property is starting to feel more like your property. So remember, principal paydown might not give you instant gratification, but it's working behind the scenes, making sure your future self will be high-fiving you all the way to the bank. Now let's move on to the juicy bit, operating cash flow. I like to call this the monthly paycheck from your property, minus the nuances, expenses. So here's how it works. Let's say you own a property and you are renting it out for $1,500 a month. Sounds great, right? But hold your horses. We've got some bills to pay. Your mortgage is, let's say, $1,000. Property taxes and insurance are another $300. And then you've got water and maintenance, maybe another $100 a month. Imagine those dollar bills flying in and flying out, kind of like a money boomerang. Only you get to keep some at the end. So if we do a simple math, $1,500 in rent minus your total expenses of $1,400 leaves you with $100. That's $100 of pure cash flow every month on top of the property appreciation and the principal pay down. Think of it this way, it's like getting paid for binge watching Netflix. Except in this version, you don't feel guilty at the end of the binge because your wallet is heavier, not your conscience. And you tell me, why is this cash flow so sweet? It's not just that $100 bill, is it? It also gives you financial freedom. It's money you don't have to work an extra hour for. You don't have to deal with grumpy bosses or even change out of your pajamas to earn it. In other words, it's passive income. It just flows into your bank account like a stream of financial nirvana. Now, keep in mind, your cash flow can vary. If your property sits empty or you face big unexpected expenses, like replacing a roof or battling an army of termites, your cash flow could dip or even go negative for a short period. So, always have a financial cushion. Think of it as the seatbelt for your money car. Alright folks, last but definitely not least, tax deductions. Who wouldn't love paying less to Uncle Sam? It's like finding money in the pocket of your old jacket. If you're making less than $150,000 a year or qualify as a real estate professional or own equity in profitable businesses, congratulations, you've hit the jackpot. The IRS practically rolls out the red carpet for you. It's like they are personally inviting you to dodge a few tax bullets. Legally, of course. You may ask, if I'm getting a check from my tenant every month, don't I have to pay taxes on that income? Good point. It seems that you are following along excellently. Well, the secret is in depreciation. See, roughly 80% of the price you pay for your house is in the building and its improvements, which are depreciable over 27.5 years or faster if you use cost segregation or take accelerated depreciation. Too much jargon here, but those are lucrative loopholes for another day. So back to the normal depreciation. If you buy a property for $300,000, 80% of that would be $240,000. Divided by 27.5 years for residential use, you get $8,727 per year, or $727 a month. Remember that $100 of positive cash flow you get after paying for expenses each month? Now you take off additional $727 for depreciation. That results in a book loss of $627 a month. And again, if you're making under $150,000 or you qualify as a real estate professional or a passive investor of profitable business, then you'd be able to use that loss to offset your other income to pay less taxes. Whew, we've been on a whirlwind tour of real estate investing, haven't we? Let's take a moment to recap the big four, the Avengers of real estate benefits, if you will. First up, appreciation. It's your property's glow up over time. Imagine you're suddenly the first pick in basketball. Feels great, right? Next, principal pay down. Think of it like losing weight. It's slow but sure progress that one day has you slipping into those skinny jeans. Then operating cash flow. The monthly mini lottery win for just owning a place. It's like Netflix paying you for your binge watching. Lastly, tax benefits. These are the cheat codes of life, giving you more coins in the game while keeping Uncle Sam at bay. So, those are your real estate Avengers, fighting the good fight for your financial future. To add to your success, I'm hosting a free webinar called Real Estate Investing, a Step-by-Step Guide on November 9th, 2023 at 2:30 p.m. Pacific Time. I will use a real example to show you the ins and outs of the calculation, different interest rate and appreciation scenarios to see when would be a good time to buy. In the end, I will also give you the interactive tool for free. It's your next level in the real estate game. Thanks for watching, and remember to share my content if you found it useful. Not everyone is lucky enough to stumble upon financial wisdom like this, and it's a virtue to share. See you next time!